Views expressed by CamaPlan podcast guests may not reflect those of CamaPlan. CamaPlan does not guarantee the accuracy of information provided by guests, nor does it endorse or recommend any individual or organization. CamaPlan is not an investment advisor, CPA, realtor, or attorney. You are encouraged to conduct your own due diligence before making investment choices. For any tax, legal, accounting, investment, or other questions, please consult a specialist. Welcome back to the road to financial freedom, where experts share stories and secrets to unlocking financial independence. This podcast is brought to you by CamaPlan, a self-directed IRA administrator focused on educating investors on how to grow retirement savings faster through alternative investments. I'm Ricky Trong, CamaPlan team member and podcast host. In each episode, we're going to take an in-depth look at the many roads taken to financial freedom and how they differ for each of our guests. Today's guest, I'm joined by Brett Swarts. He is an entrepreneur, CRE investor, podcaster, capital gains tax deferral expert, and so much more. So now let's hear the story directly from Brett himself. Hey, Brett, welcome to the show. How are you?
Ricky, so good to be here. Excited to bring some value to you and your listeners.
Yes, we're very excited about that. And you have so much going on for you. So I definitely want to hear all about your journey. Tell us a little bit about your background, how you got started, and then where you're at today and what you're looking to do moving forward.
Absolutely. I fell in love with alternative investments, although I think that I actually like to think of them as primary investments in that they're real estate themselves, a cash flowing, producing assets at a young age with a mom and dad. This isn't actually the Silicon Valley, Bay Area, Mission, San Jose, Fremont area. Growing up, we would build houses and then my parents would rent them out and or just sell them and develop them and do construction. And so I was in that entrepreneurial business mindset from a young age and didn't know my future would be in real estate or exit planning for people who are selling assets that are high end. But I fell in love with the sticks and bricks of real estate and kind of being an entrepreneur at a young age. I had a chance to go to college, play some basketball in college, which was one of my dreams. And then I had a chance to take an internship at a place called Marcus and Millichap. And for those who don't know what that is, it's just a real estate brokerage firm, but it's specializing in commercial real estate. So my specialty was actually multifamily investments here in the Northern California area. And we started to help people buy and sell real estate using things like 1031 exchanges, but it wasn't always easy. The marketplace in 2006 at the time when I started was, red hot, but then it quickly became one of the hardest hit markets, or the market itself in 2008 crash. So I went from making a little bit of money to almost nothing overnight. And I remember being scared and frustrated with my career and where things were going. And my wife and I had to move into our condo with my brother and I had to take a side place job at a place called Cheesecake Factory, and just began the journey of financial struggle, but also a way to innovate and serve people, because not only was I going through a struggle financially in a 100% commission type of sales position, but my clients were losing half or all of their wealth because they hadn't done enough diversification and they were too over concentrated and they were doing what's called 1031 exchanges and overpaying for properties. And so we started to really identify that the 1031 exchange is not always your friend, and soon learned something called a deferred sales trust, which has changed the way that myself and clients and fans and family build wealth, which is exiting when it makes sense for you and diversifying into properties or different asset types that make sense for you. And so that's kind of the journey. My wife and I have 5 kids now. She's been able to stay home full time with the kids. That was one of our values. We live here in Sacramento, California.
Wow. That's a lot going on there. But so you had mentioned 1031 exchange. So maybe for our listeners that haven't heard that term or really understand what that is, could you go into a little bit of detail as to what that is and maybe explain how that is different from a deferred sales trust that you had mentioned?
Absolutely. Yeah. So a 1031 exchange is an IRS tax code that allows investors to buy investment property. And then when you sell it, basically trade or exchange it into another investment property and defer capital gains tax. So we have things like IRC 401k, IRC 1031 exchange, IRC 453. These are different tax codes that if you follow the rules, you can defer tax and you can grow your wealth. So let's say you buy a fourplex for $250,000, and let's say you're going to sell it for 1.25 million. That's about $1 million gain. In California, for example, even in Pennsylvania, it's pretty high as well. But California, the minimum is going to be a 37% tax on that gain. So let's just say it's $1 million gain. That's $370,000 that's going to be taxed, unless you do what's called a 1031 exchange or a deferred sales trust, which we'll talk about here in a second, and you buy something for at least $1.25 million, and something meaning an investment real estate property, within the short period of time. And this is where the 1031 exchange is really not your friend in a marketplace that you have rising interest rates, you have very low inventory, okay, and you still have relatively high pricing, because what happens is you sell high and you buy higher 180 days later. That's the other rule you have to do. You have to buy and sell within this short period of time. And we call this the shotgun wedding. We all have maybe friends that got married a little bit too quick. They get engaged, they get excited within 45 days, but then they get married really fast. It's not always a great thing and a great investment. We call it letting the tax tail wag the investment dog. And so enter the deferred sales trust. It's an alternative, and it eliminates the need for the 1031 exchange. And the number one thing that it does is it allows you to not have to suffer the time consequence, meaning you can sell high and buy low. In fact, one of the best deal stories we have for this, that actually was one of the pivotal reasons why I started my company, was the ability for a gentleman in 2006. He sold a $20 million real estate property in Minnesota, deferred the tax using a deferred sales trust, waited 5 years for the market to shift. And in the meantime, he put it into stocks, bonds, mutual funds that were in a very conservative investment allocation, not subject to the huge crash of '08. And was able to use that money in the trust to buy back the same property that he sold, but he bought it back at 60 cents on the dollar when the bank called him up and said, "Hey, we just foreclosed on that property you sold to that 1031 buyer a few years ago for that record price. Would you like to buy it back?" And he said, "Well, give me a couple of days." And the way we help our clients and investors structure deals, you can buy properties without having to do a 1031 exchange, still defer the tax, and essentially purchase at optimal timing, which to us, that is the number one way to build wealth, is being able to time, dollar cost average, diversify, and not have to buy something just because the tax tells you have to.
Wow, that's really interesting. And thank you for explaining that. I didn't even know all that. So that's really knowledge to me. And I appreciate all the knowledge I can learn. So that's why we're doing this, right? To teach and to broaden our knowledge as well. So that's really cool, because earlier this season, we actually spoke to another podcast guest, and he had mentioned a sales, I want to say it was a spendthrift trust. So it sounds like it's definitely different than that. And there's so many different aspects to, keeping that wealth within your own, entity. So that's awesome. Thanks for that extra information here. There's so many things that you do. I mean, it's amazing. So you have your own podcast, and you really love to help clients, with tax deferrals, because that's what you are. You're a tax deferral expert. So I love that you have stories pertaining to that. Are you considered a wealth advisor as well? Is that what you would be considered in?
Good question. So my actual role at Capital Gains Tax Solutions as the founder is actually the trustee. So every deferred sales trust needs a trustee. And then we actually work with wealth advisors who provide the securities licensed professionals that provide the allocations and the investments for stocks, bonds, mutual funds. And so we partner with, I would say, strategically align with advisors across the country. So part of what I do is I coach and train advisors on what this deferred sales trust is. Imagine if you're an advisor, you didn't know what an IRA was, right? Or imagine you were a commercial real estate broker agent and you didn't know what a 1031 exchange is. So what I do is I go in and I teach the differences of the 1031 exchange versus the deferred sales trust mainly. And then I empower the financial advisor with the strategy so that they can go market and educate as well when the exit of the business or the cryptocurrency or the primary home. Which is, by the way, another little nuance here. The 1031 exchange only works for investment real estate, whereas the deferred sales trust, we call it like Netflix versus Blockbuster. It's Netflix because it works for every asset type. Cryptocurrency, we just closed a $5 million cryptocurrency Bitcoin sale for a client who bought it for $50,000 and sold it for and it went up to 50 million. She exited 5 million of that and deferred about 1.85 million of tax. And from there, it can be invested into stocks, bonds, mutual funds, diversified. And that wealth advisor, we work with them. Okay. Now, I'm a commercial real estate expert. You could say I'm an advisor for commercial real estate, if you will. I'm a broker. I'm an investor. That's my expertise. So there are a lot of investment real estate owners who are selling, and they like that additional value that I bring there. So that's sort of how we work, Ricky, if that makes sense.
Yeah, no, definitely. Thank you for explaining that. That's great. We work with a lot of advisors here as well at CamaPlan. So it's interesting to hear it from your side because we're seeing it from this side where they're advising the client on what to, not specifically what to invest in, but how to use the vehicles of investment to greater their wealth. So it's interesting to hear it from the training perspective, and that's how they help our clients as well. So it's like a big circle. I love it.
Yeah, at the end of the day, we're all just here to solve problems, right? I actually just tell everybody, like, you're not in the business of selling self-directed IRAs. I'm on the business of selling the deferred sales trust. The wealth advisors aren't in the business of selling stocks or bonds or mutual funds. We're actually just in the business of solving problems. And to the extent we can help our clients solve their problems and help them get what's called A to B, A being where they're at now and some of the challenges that are going on. And a great analogy for this is like a Rubik's Cube. Everyone shows up and it's a little bit different, right? And it's a little bit out of whack. And if you're not seeing this, imagine a Rubik's Cube with all the different colors on the different ends, all kind of mix matched, right? And you show up to Ricky and you show up to Brett and you bring a wealth advisor and you build this dream team. And collectively, we're going to try to move as you clarify what your ideal outcome is, right? And your ideal outcome, if you're looking at another Rubik's Cube, would be completely, congruent. And that could be your lifestyle, that could be retirement, that could be being more entrepreneurial, that could be, giving, if you're charitable giving, that could be, more cash flow. It could be looking at tax flow. And so we just love solving problems. We love working with clients. We love working on teams with other advisors. And we love that you guys are in the space too of the self-directed IRAs because we believe that it's great to have more alternative investments. And again, I say alternative, but I think we should switch it. I think the real estate and the things that we, perhaps I'm thinking, maybe you can tell me a little bit more about what you guys do as well. But the Wall Street world, they always say, "Oh, this is the primary." Right? I'm like, well, really, is it? Why is that the primary? Right? We like to say that things that we can control, that we can run, that we can build ourselves, right? Businesses and real estate, and things that are very tangible. To us, that's the more of the primary focus for at least for all of our clients.
Yeah, I mean, we handle it all here, honestly. I mean, we see it as all as investment opportunities, not specifically, alternative, but some of it can get a little weird that people just didn't know you can invest in. And I think that's where the alternative term comes into, because some people didn't know that you can invest into mortgage notes or you can buy a house through an IRA. And that's what we're here to do, is just to educate as well. So yeah, I mean, we'd love for it to not be quote unquote alternative and more mainstream, obviously. And I think that's what we're all here to do, is just to get that information out there to let people know there's other options besides Wall Street. Definitely.
Perfect. Exactly.
Yeah. You've talked about Bitcoin. We have investors involved with, all types of crypto and precious metals and things like that. So what is like a good way for like tax efficiency? Like, do you have a specific, mainstream way that besides, I guess the deferred sales trust would be that, or the 1031, just finding the best alternative for that client? I mean, what's your process when you're talking to a client maybe and figuring out what's the best route for them to take?
Great question. So first, it starts with what do they even qualify for, right? So you mentioned Bitcoin, right? We've done Bitcoin, we've done Ethereum, we've done public, private stock, we've done investment real estate, we've done primary homes, luxury homes, captive insurance, carried interest, saving a failed 1031 exchange. So the answer is it all depends on A, what they qualify for, B, what the timing of the transaction is, and then, but the most important thing is really C, like what's their ideal outcome? Like, well, what are they trying to achieve, right? Is it estate tax elimination? Well, we just did a deal out of Colorado. It was a $25 million client who sold a $5 million property. And their biggest thing was all 25 million was inside real estate. So they weren't really diversified too much. But number two, all that 25 million is inside their taxable estate. And so without giving it all away to charity, and something wrong with giving to charity, you give to charity, but they weren't ready to give it all away to charity quite yet, without buying a bunch of life insurance and without having to have a bunch of kids to try to gift it all out, they were able to eliminate the estate tax on that $5 million by using what's called the DST 2.0, the DST plus, not to be confused with the Delaware Statutory Trust. This is a deferred sales trust. And that's really the power of clarifying what the true need and challenge is. And to clarify further for folks, if you're worth more than 24 million married or 12 million single, your estate, and if it's all of your capital is inside your taxable estate, is subject to and/or assets are subject to a 40% death tax. We call it the government's biggest mousetrap, right? And there's a stat according to the American Bankers Association and a ton of other studies that there's about $32 trillion that's going to pass from one generation to the next in the next 18 to 20 years. And this is known as the largest wealth transfer in the history of the planet. And Ricky, these are our parents, a lot of our parents that are baby boomers that are passing it to us, mostly us, millennials, that is, right? That is this huge transfer of more wealth in the history of the world that we know of. And it's tied to three primary assets. And the assets represent 50% of the total wealth in America, which is high-end primary homes, commercial real estate, and private equity and/or businesses. Now, these are all three illiquid assets that are highly appreciated, that clients are looking for solutions to either downsize and travel more, looking to retire from their businesses, looking to increase their cash flow, looking to eliminate the estate tax, right? And they don't have a clear solution. So part of what we do is we just try to map out with them their options and then strategize which one might fit the best, and then help them execute on that plan. And sometimes that involves us completely. Sometimes it means, sending folks to someone like you guys, Ricky, where you're doing the self-directed IRAs, because we can't do IRAs. You can't exit an IRA into a deferred sales trust. People call us like, oh, I've got a 401k or not. Can I do that? Like, no, you're already in a different vehicle. You stay in that lane once you're in that lane. But for us, it becomes the exit of an asset. Typically $1 million net proceeds, $1 million gain is our minimum. So it's got to be big enough. We work on a conditional basis, meaning we'll look at the whole deal, we'll analyze it, we'll give you options. We'll talk with your M&A advisors, your business brokers, your real estate agents, your CPAs. We'll go through it all. If it doesn't fit, no harm, no foul. It's great. But honestly, like, as long as you don't need all the capital right away to spend on a bunch of personal stuff, you can put it into investment vehicles such as stocks, bonds, mutual funds, crypto, businesses, mortgage notes, cryptocurrency. You're able to keep it in a tax-deferred state. And that's pretty cool, right? Because if you get a zero interest loan from the government, Ricky, when would you want to pay that back? No, you wouldn't want to pay it back. You can keep it going for as long as you want. You can pass it to kids. Now, as you receive payments from this trust, and most of our clients will take interest-only payments, you get taxed, right? And that's the tax flow part. To kind of answer your original question, we're going to look and we're going to kind of customize this trust to start making payments based upon what's best for you. And I'll give you an example of this. We had a client in Palo Alto. We helped him sell an $8 million primary home right on University Avenue, and he deferred about $800,000 of tax. Now, he was moving to Nevada. So guess what we did? Well, we timed the payments to be, basically once he gets to Nevada, which meant he is subject to Nevada state income tax and not California income tax. So that was a little strategy there. Now, if he ever dips into the principal, he'll always pay California's cap gains tax. So it's not tax avoidance, it's just tax deferral. But the cool thing is California is happy too, because there's new property tax, right? On the new $8 million number. There's the real estate agent who had to pay the tax on its fees. There's us who pays the tax. There's a lot of still tax revenue that's generated. And that's what the biggest thing for people. They think, oh my gosh, how can this be true? How can this be legal? Well, it goes back 26 years, thousands of closes, billions under management, but you have to have a team to execute it and follow the rules. Otherwise, yes, you can get in trouble. There's also a lifetime audit defense that the tax team who created the structure provides, along with with capital gains tax solutions with the deferred sales trust. So I know that's a whole lot, but hopefully that answers the question, Ricky.
Wow. Yeah. You had mentioned the Delaware Statutory Trust, I believe. Could you tell us a little bit about that and how it's different than the Deferred Sales Trust? Because we didn't talk about that yet. So that's very interesting you brought that up.
It's a great question because they get confused all the time because they're both DSTs, right? And most people have heard, oh yeah, I've heard of a DST. And then they go, whoa, did you hear about the Delaware Statutory Trust? They're like, yeah. And so you haven't heard of a Deferred Sales Trust. Okay, so back to the Netflix Blockbuster analogy. And I want to tell you that Blockbuster is a 1031 exchange, right? You got to get the 45-day, you got to get the 180. It has to be like kind investment real estate property. There's really no diversification. There's no liquidity. That's Blockbuster. So the Delaware is in the Blockbuster family. Okay. You have to get the movie on a Friday night. You had to drive there in the snow if you're in Pennsylvania, right? Or the rain. You got to, if it's behind the box and it's still there, you got it. You got to drive home. You got to rewind it if it's, or the DVD is scratched. You got to return it within 3 days. I mean, it's just really inefficient, right? And it can be really challenging. That is like the Delaware 1031 exchange. The difference with the Delaware versus, and I call it Delaware 1031, is actually a better name. What you're doing is you're selling an investment real estate property and you're moving it into basically a larger portfolio or a couple properties with a very large corporation that's doing all the management. It does have some positives. You don't have to do the management. There's typically non-recourse loans, and these deals are your Class A properties, beautiful properties in great locations, but there's huge fees for that. In fact, as much as like 15 cents of every dollar goes into the real estate, or does not go into the real estate. Only about 85 cents of every dollar goes into the real estate, and about 15% all these fees in the middle. And I was a Series 2263 licenses, so I've closed Delaware Statutory Trust. They're huge fees, and you have to ask yourself, is this the best use of my capital right now? Now, we also use Delaware Statutory Trust, a positive, for mortgage over basis deals where people have debt over basis, because one of the Achilles heels of the Deferred Sales Trust on the Netflix side is that it can't defer tax when you have debt excess of basis. Okay. So what we do on an investment real estate, in fact, we just did a deal for Ron. He did a whole YouTube video on this. He and his wife sold a $4 million plus property in Denver, Colorado, but they had $1 million mortgage over basis. And so we had to do a partial Delaware 1031 where we replaced the debt over basis in a very low loan to value deal. He put about 18 to 20% down on the million. So about 180 to 200,000. And that replaced the debt. And then the rest of it, we did a deferred sales trust. So what's cool is sometimes the answer is not just one or the other. Sometimes it's both, right? And again, this is part of the depends part and the expertise. You want to make sure you have a clear plan and clear experts who have executed these plans. So you can do a partial Delaware 1031, eliminate the mortgage over basis. The rest of it can go into the deferred sales trust. So that's the Delaware Statutory Trust. Just think of it as a 1031, but you're doing it into like a syndication or a partnership. Okay. Where you have no control, no liquidity, no diversification, but you have no toilets, trash, or liability because they're doing it all.
Wow. Okay. Thank you for clearing that up. I appreciate it. I'm sure our listeners did as well. I wasn't aware of that. So that's great.
Let me touch on the deferred sales trust too, by the way. So the difference between, again, a 1031 and a deferred sales trust is not only timing, but also the ability to be entrepreneurial. And this is really important to understand. You can buy back into real estate whenever you want. You can go into the lending business if you wanted to. You can start a new business, a new tech startup. You can, what you can't do is you can't buy a primary home with the money, tax deferred. So I'll give you a couple of examples. I had a client that sold a $2.6 million business in Alabama, and he's building and has built 72 units in Tennessee, tax deferred, with the trust being a silent partner to fund this deal. We call it the go fund yourself. So instead of getting funding from a bank or from another investor, the trust, which owes you the money, I don't know if we've even explained how this whole thing works. Like if Ricky is selling a property or a business for 2.6 million, she can have all the cash come to her at closing, and then she's going to get triggered from, say 25 to 50% in tax on the gain. Or she could say, you know what, I'm going to sell the property or the asset to the trust in exchange for a loan, right? I'm going to get a promissory note, and this trust is going to owe me this 2.6 million plus a rate of return over time. And in the meantime, that trust can just be in passive investments with a wealth advisor or into passive real estate deals. Or it can also partner with you, Ricky, on another deal where you are the owner of a new LLC, and that new LLC is buying more real estate or buying more property, buying another business, right? So there's that cool entrepreneurial freedom aspect of this, right? Where if you go, you know what, I'm selling now, but I want the ability, I think the market's going to shift in about 12 months. I think I can find some deals coming up. And in fact, I think I can find some excellent opportunities. How does this deferred sales trust allow me to do that? And so that's the cool part of the deferred sales trust, is you can be very entrepreneurial with it.
Wow. Thank you. So you have a podcast, correct, Brett?
Yes.
So what kind of subjects or what kind of topics do you normally talk about on your podcast? Is about stories of these exchanges and these different wins that basically your clients are having, or do you touch on other subjects?
Yeah. So really, we try to bring in the best, real estate, crypto, business, leadership, and wealth minds in the world to share their ideas, deal stories, and inspiration, right? So, collectively, we can make passive income plans achievable, as well as capital gains tax deferrals strategies simple. And that doesn't always mean someone's in the 1031 exchanges or Delawares or deferred sales trust or CPAs. Like some people, oh, it's because it's called the Capital Gains Tax Solutions Podcast. So they're, oh, I'm on the tax world. It's like, it's okay. Bring how you help solve problems, right? Bring how you have a special gift and a special unique product and a special service that helps your clients create and preserve more wealth, or help them grow their business, help them grow their leadership, right? And so, end of the day, these things all come into play, right? You've got to have the major parts of a business, of team, of organization, and then exit planning. And that's when we come into play when you go to exit your highly appreciated assets. So yeah, that's that we try to bring in some extras. We had people like Kevin Harrington from Shark Tank on the show one time, and he talked about becoming a mentor to millions and how he's giving back by mentoring and helping people to be the best, at what they're doing. And so that was a really cool guest. We've had people like Joe Fairless, who's a commercial real estate syndication expert in multifamily. We've had CPAs, tax professionals. We've had people who lead leadership groups and tech companies. I mean, it's really pretty diverse.
That's awesome. It's fun, isn't it? I mean, we have the similar kind of, not on such a high scale, but we definitely have the same kind of opportunities here. So it's been really fun. You had mentioned exit strategies. Have you ever had like a failed exit strategy, or how do you avert a failing exit strategy?
It's a great question. So time and pre-planning, and I really encourage everyone who's listening to this to pre-plan your exit before you exit. What does that mean? Well, a lot of people want to say, well, let me line up the real estate broker. Let me line up the M&A advisor. Let me get the deal going. Let's even see if we have a deal. And then, a couple weeks or 30 days before closing, they go, okay, oh my gosh, I got this tax. Let me go solve for that. And it's just the opposite. In fact, if you go too late in a deal, you disqualify yourself. What does that mean? Well, if the buyer has removed all contingencies in a deal and it's set to close in a couple of weeks or even a day, whatever, if they've removed that basically triggers what's called constructive receipt. Constructive receipt means the money's coming to you and there's really nothing that you can do about it at this point. The deal is going to close and you're going to pay tax. Whereas where we like to plan is to go well before, right? So, and there's two reasons for that. Not only the first one I just said, but the second one is emotionally, think about this, Ricky. If you owned and built a business for $100 million and you've done it for 20, 30 years, and all of a sudden you're hearing Brett Swarts and Capital Gains Tax Solutions on a podcast or a YouTube channel, you're watching this and you're going and you've got 20 days to close and you've spent probably 2 years selling this asset, with the planning to even get the M&A advisor to all the underwriting. Like, what are the odds emotionally that you're going to be able to be like, oh yeah, let's just move the $100 million over there to this tax deferral strategy I've never heard of, and I'm learning about it for the first time. I mean, it's overwhelming, right? So we see this day in and day out. So what we say is we have enough time to spend with you and enough time to show you and talk with our clients, talk with the banks, right? Talk with the tax attorneys, you talk with your CPAs and go through it. And we just slow everything down and we pre-plan. Then we have like a 99% close ratio. It's great. Where we go lower is when either people have procrastinated or not even meaning to. They just didn't really think, or the advisors didn't tell them to plan their exit before they're actually in escrow ready to close, and they just run out of time. And or the buyer won't cooperate fully because they don't know what it is. And so really the biggest thing is time. And so that's part of why we work on a conditional basis too. We don't charge anything unless the deal closes, and if you want to use the trust. So you can actually pre-plan, get the trust, get everything set up. We work with your advisors, your M&A attorneys, CPAs. We do it all. And if for whatever reason, like you could just be like, I just don't feel like it anymore, or the deal doesn't close, you owe us $0. We take all that pressure off. That's how much we believe in what we can provide. But we encourage you to get with us early, so no one's running around on a fire drill, and you get a chance to really vet out the structure, the strategy, and how the plan's going to work out for you and your family.
Wow. Yeah. I mean, that's pre-planning. It's hard to think about when you're just like, you're not in that process, but you always want to predetermine things. I mean, that's why people have life insurance. And I mean, they're pre-planning, unfortunately it's kind of morbid, but they're pre-planning their passing and things like that. So, I mean, why wouldn't you want to pre-plan something as important as, dissolving a business or, buying something large or getting out of a large investment? So yeah, I totally understand. And that makes so much sense. Yeah, you had mentioned that, you don't charge anything up front until, it's closed and, you've won basically. It sounds almost like a lawyer kind of like setup.
Yeah, it's a lawyer, but it's like a real estate professional. It's contingent upon the close. But the cool thing is, even if it doesn't close or you don't want it to close, you owe us $0. or
That's
you decide not
awesome.
to use it. So it's even better than that. We just literally take all the pressure off and just say, use it, don't use it for whatever reason you don't, no problem. If you do use it, you pay us.
And that's great. And that's got to make your clients feel trusting in you and really want to work with you because they know that they're not losing, but they're gaining so much no matter what. And it would make them want to partner with you long term anyway. So that's great.
That's what exactly we found precisely.
Yeah, that's great marketing coming from a marketing specialist. So that's awesome. I have a quick question though. So when you are gaining a client or you have someone that wants to call in for a consultation, what are things that you would hope that they have like together for you that you need to know so that they can make that call as efficient as possible for
Just
you?
probably 5 things. 1, what's the sales price or estimated sales price? 2, what's the estimated debt on the asset, if any? 3, what's the estimated adjusted basis? 4 would be what's the entity that owns it and or partners, is it LLC, S Corp, C Corp. And the next one might be what's the timing of the sale, right? So with those 5 pieces, we can quickly determine A, if you qualify for the next step, and B, if the deferred sales trust could be a good fit financially, because the numbers have to make sense, right? And again, we'll just remind it's $1 million net proceeds, $1 million gain per transaction. Unless you have 2 at 500 each, you can combine in a short period of time. And as long as you have that, then the deferred sales trust we found is a home run, right? No matter what state you live in, no matter what asset you're selling, a $1 million gain and at least $1 million net proceeds, it's a home run. Anything less than that could be, a triple or a double or a single. And we typically don't like to do doubles or singles, right? We want to do triples and home runs. But there are times in certain circumstances where we will be open to that. And sometimes that means they're in like a New York or California, a place that are so highly taxed, they might have, a 750 sale and a 750 gain, but because they're in a higher tax state, versus like a Texas or a Florida where it has no state capital gains tax, right, then that, we can deviate a little bit, but generally speaking, have those numbers, then it works. And that's it. And then just come prepared to just talk about your vision for your wealth plan and what it means to you for your legacy, for your family, and what that means to you to have that extra cash flow, that extra cool tax flow strategy, and see if it could be, you have a good fit working with us.
Definitely. Yeah. I mean, being prepared for that is always great. And thank you for letting us know those 5 things, because then any of our listeners today that may have, this opportunity, they can have that prepared and they can give you a call, because I know that you're always taking consultations. And why don't you let us know a little bit about how we can reach you, things of that nature?
Yeah. So capitalgainstaxsolutions.com is the best place to find all about us and what we're doing. We have a free ebook there for you can download, selling your business, real estate, or cryptocurrency smarter. It's a great ebook that breaks down the deferred sales trust, the track record, and a little bit more about how it works. You can also go to our YouTube channel, Capital Gains Tax Solutions. We have a chance to see videos of clients speaking, giving testimonies on their DST deals, and other videos and other great guests that talk about building wealth. And the other thing would be the book, cool book that's coming out. It's called Building a Tax Deferred Exit Strategy. My first book. It's kind of my story and journey to this whole tax deferred world. Didn't grow up a CPA or tax attorney. I just worked with this, I think, the smartest person in the field for that in the country. He's amazing. He created this deferred sales trust. And I've got a chance to share that story of how I came to the deferred sales trust, my journey as well. We have people like Kevin Harrington from Shark Tank in the book, which is pretty cool. And other really smart folks. So that, they say to get in the room with, 5 people that are smarter than you. So I try to get in the book with we have about 13 or 12 different, chapters with different guests in the book. So I just try to get in the room with 12 smarter people, and that helps me to get a little bit smarter.
That's great. And that's how I feel about this podcast. I'm always bringing in people that are either experts in their field or smarter than me in any aspect of investing. And I want to make sure that I learn from them. And I've learned a lot from you. So I'm definitely going to check out your book, and we'll have it all listed in the show notes. Capital Gains Tax Solutions. You can find him on his website, podcast. It's Brett Swarts. I just want to say thank you so much for being here with us. Do you have any last maybe words of wisdom or a fun story that you'd like to share before we get into the ending here?
I mean, just I think encourage everybody to learn to work harder on yourself than we do on our jobs, right? We do get really passionate about talking tax and cash flow and wealth building and helping clients. But I want to encourage everyone to I have to encourage myself every day to work harder on our leadership, our personal development, our faith, our fitness, our family, all of those really important eternal stuff that's going to build a character, build a legacy with the family versus just the external, which is wealth, which is a part of it too. So just work harder. And it's a quote by Jim Rohn. And basically he says, if you work harder on your job, you'll make a living. But if you work harder on yourself, you'll make a fortune. And that fortune is what you can become, right? And that character and that development, that leadership. So just I want to encourage people to do that. And I also say it too, because it helps to encourage me to continue to focus on that as well.
That's great information and very inspirational. I love it. And I'm going to definitely work harder on myself too, because everyone can use a little improvement, no matter how great or how happy you are in your life, improve something. So I love those words. I think it's a great way to end this today. And Brett, I'm just so appreciative of you being here. I learned so much. Again, our clients and audience, if you have any questions for Brett, please feel free to reach out to him. He's more than happy to work with you, help you on your way to success. So again, I just want to thank our sponsor here, CamaPlan, and of course, Brett Swarts again. If you're looking for any information on a self-directed IRA, please go to CamaPlan.com. You can request a consult with an expert, view our media library of webinars, or open an account today. Thanks again for listening, and remember to like, follow, and share our podcast, The Road to Financial Freedom, to continue with us on this journey on the path of finding success. Thanks so much. Have a great day.
Bye, everybody.
Bye.